Welcome to this FundForum webinar. I'm Jenny Adams, Editor-in-Chief of FundForum International. We'll also be live tweeting this webinar, so do join in the conversation using the hashtag FFwebinar. Emerging markets are recovering after a challenging couple of years. With all of these headwinds, what does this mean for the long-term investment case in both equities and bonds in emerging markets? While there is an inherent volatility in investing in emerging markets, it's possible to build a more resilient, lower risk approach. I'm joined on the webinar today by Richard Carlyle, Investment Director at Capital Group, who'll be discussing this key theme. Richard has 34 years of investment industry experience and has been with the Capital Group for 10 years. Prior to joining Capital, he was head of equities for Henderson Investors. Before that, he was a fund manager for Morgan Grenfell Asset Management, a pension fund manager for British Petroleum, and an analyst for Equity and Law Life Assurance Society. He holds a bachelor's degree in economics with honours from Leicester University, and Richard is based in London. If you have any questions throughout the presentation, do send them to us using the blue Ask a Question button at the bottom of the screen. We'll be holding a live Q&A at the end of this session. So now I'll pass over to Richard.
Thanks, Jenny, and thanks everyone for dialing into the webinar today. Thanks very much. Just by way of introduction, I'm going to say I use a couple of pages to talk about the Capital Group, just some quick background. We were founded in 1931 by Jonathan Bell Lovelace, who you can see on the screen in front of you. We are an employee-owned asset manager who does only long-only asset management, and whilst it's not one of our objectives, you can see that we are the second largest active equity manager in the world after Fidelity, with around $1.4 trillion of assets under management. And if we look at a little timeline of our history on the next page, you can see that it shows there, founded in 1931. We opened the London office that I'm in today in 1979. And because we're talking about emerging markets, we began managing the world's first emerging market equity fund in 1986. A very long experience in running emerging market portfolios. In the 2008-2009 period, we opened our research offices in Beijing and Mumbai. And more recently, we've expanded our European offering with new offices and new offerings from our American funds range. So that's the background to Capital. So if we just flip a couple of pages, we can look at what's happened in emerging markets in the last 5 years. And as Jenny says, they have lagged. The chart in front of you shows the blue line is how developed market equities have performed in dollars since the end of 2010. And you can see the grey line, emerging markets, lagging quite badly. It looks like this year will break the trend of emerging markets doing less well. Year to date in dollars, we have emerging markets up around 10% and developed market equities up around 7%. So providing the year doesn't change in the next couple of weeks, we will break that trend. But overall, it's been a disappointing period for emerging market equities. So why has that been? If we flip to the next page, one of the main reasons we show is that it's emerging market currencies. If you look at the grey line here, which shows emerging markets in local currencies, that's actually been a respectable performance. You can see that they're not far off their the recent highs. It's when you translate that into dollars, it's the currency weakness that you see the disappointing returns. And really that started from the end of 2012. From that point on, emerging market currencies have done poorly versus the dollar. We do show year to date that trend reversing, with the dollar return actually a little bit above the local currency return. So part of it is currencies. Another part of it on the next page is the peculiar makeup of some of the emerging market countries. So with a big exposure to things like energy and materials, the end of the commodity super cycle, as it's been called, has hurt some of those economies and some of the larger companies in emerging markets quite badly. And that chart shows just the prospective earnings per share of a few sectors, but energy and materials really are significantly less profitable than they were at the end of 2009. So that's hurt them recently. Let's just remind ourselves of the long-term bull case, though. So on our next page, we have a chart showing color-coded rates of GDP growth. This is real GDP growth out to 2020. They're consensus numbers, they're not ours. And basically it says that if you want GDP growth above the 3% range, which is the light blue color, you have to look in emerging markets. There's actually an interesting, in virtually all the developed world growing in the sort of 0 to 3% range. If you want 3 to 6, 6 to 10, or even occasionally you'll get more than 10% growth where specific projects boost a particular country, you need to look in emerging markets. So you are getting faster economic growth. If we flip one more page just to put emerging markets into context, we see that if on the left-hand side, when we split emerging markets into EM, ex-China, and China, just so you can see the scale that China gives to emerging markets. But emerging markets are around 17% of global stock markets, 83% developed, 17% emerging, and yet in the middle polo, emerging markets account for around 39% of GDP. 24% non-China, 15% China. And if you look at the right-hand polo, you can see that emerging markets in total are around 60% of global GDP growth. So our sense is that as equity investors are very focused on GDP growth, that 17% share slowly over time is going to rise. We don't know whether that will be through superior share price performance or more share issuance, but surely as a combination of that larger contribution to GDP growth, emerging markets have to grow as a percent of world stock markets. So what are we paying for that growth at the moment? Well, if we look at on the left-hand side of this page, we've got the expected EPS growth of various parts of the world. Japan, the slowest, just under 10%. The US, after a good run, growing around 11%. Weak, strong dollar will reduce that, if anything, going forward. Emerging markets, though, growing alongside Europe at something over 12%, so pretty rapid growth. On the right-hand side, and if you look at the right-hand side of the right-hand part of the page, you can see emerging markets on only 12 times earnings on a forward PE basis, significantly cheaper than Europe and Japan, and very significantly cheaper than the US. I mean, a PE of 12 versus 17. So you do have faster economic growth, you have faster earnings growth, and you have lower valuations for equities. So certainly valuations are no hindrance to equity markets performing better. If we look quickly at debt, in a way it's a similar situation, and just again by way of background, this page shows that emerging market debt categories are large. You can see they're all many hundreds of billions of dollars and varied, more than 60 countries. We have the hard currency, the local currency, a significant proportion of inflation-linked debt, and a growing share of corporate debt. So it's a large and varied universe. And if you look on the next page, we put some bullet points around the sort of strategic long-term bull case. On the one hand, we think you can sensibly expect higher investment returns. The search for yield will continue to seek out high-yielding countries, and we'll show you that in a second. There is the potential to capture improved credit trends. If you move from developed market bond portfolios to emerging market bond portfolios, you are diversifying. The emerging market debt is lowly correlated with traditional fixed income returns. And on the right-hand side, it is a way of getting access to the growth in some of these economies. We put deepening local markets with local buyers, and the point here that is if you're an Indonesian pension fund and you're having money flow in from your workers, one of the first places you're going to look to invest is in Indonesian government debt. So it is an attractive way of capitalizing on the strong growth of some of these countries. Again, what are we paying for that attractive growth? Well, our chart of real yields shows that on the right-hand side you can get positive real yields in developed markets if you look hard, but many of those countries, UK in particular, Sweden and Europe, are giving you negative real yields, whereas in emerging markets you have a range from Poland and Korea up to the slightly more risky maybe Brazil and Uruguay, giving you 5-6% real returns. So our sense is that again you're not being asked to pay a high price for the faster growth you're seeing there. We did mention currencies, so just to stand back and look at currencies, excuse our complicated chart on this page, but what we've done for each of the major emerging market currencies, and you can decode it at the bottom using those three-letter acronyms, is look at how the currency has moved, and we use a real effective exchange rate against the dollar over the last 10 years. That blue bar shows the range with which the currency's moved, and the orange line shows you where the currency is now. And with the exception of India, which is INR, with the exception of Indonesia and maybe Israel and Korea on the right-hand side, I mean, the orange line is generally at the low end of those blue bars. So all we're saying is that versus the last 10-year history, emerging markets look cheaply valued, no more than that. So certainly currencies look well placed for a rebound. There are lots of external factors influencing emerging markets. We list some of them on this page. I won't go through them all. I'll let you read this at your leisure. But, supportive central bank policies are important. We expect that to continue, although we observe, like many, that additional quantitative easing seems to be losing its impact. So maybe other measures will be required. On the left-hand side, we talk about sustained recovery in China, and obviously the recent election of President-elect Trump. We'll probably cover that in Q&A, but obviously that's adding uncertainty. We'd say probably particularly relevant for China and Mexico, but we may cover that in questions. So if we turn now to ETOP, and as Jenny said at the beginning, the idea with ETOP is to give investors access to emerging markets, but with a less volatile or less risky approach. Well, why do we think that's relevant? Well, page 15 is a bit of a maths lesson, and we just compare the returns on the emerging market equity index. And if we look back at 2008, 2009, EM equities fell a horrendous 54% in 2008. They had a huge bounce back in 2009 of 82%, but the maths is such that still leaves you 16% less well off than at the start of 2008. Controlling downside risk is important because for ETOP, I found the returns were minus 22% in 2008, a nice bounce of 42% in 2009, and if you do the maths, that's an 11% return. So protecting on the downside, we think, can boost your long-term returns, and you get a similar pattern in the 2011-2012 phase when equities gave you a negative return, ETOP again positive. And it's very relevant for emerging markets because if you look back at the history and if you look in the 1994 to 2004 period, there were two declines of more than 50%, and that really does ruin your long-term returns. So we think, particularly for emerging markets, protecting on the downside is important. That's the background. Let's say a little bit about the fund and the benefits of a broad approach. If we stand back and look at the objective, on the one hand, we are trying to capture growth. We use a broad opportunity set, so across equities and debt and currencies to capture that growth. And at the same time, we try and manage risk. And that means moving from equities to debt, occasionally currencies, and we can hedge those currencies back into the base currency of dollars, etc. So all of those are the way we manage risk. And the ultimate goal, as it says at the bottom, is to give investors emerging market equity-like returns with less risk, and we'll see how we've done on that objective in a couple of pages. We talked about a broad opportunity set. Well, that is summarized on page 8 on this page here. On the right hand side, you've got the bond universe. You've got the original Brady bonds, now sort of hard currency emerging market debt. You've got local currency bonds, the interesting area of inflation-linked bonds, which have given investors good returns. And you've got the sort of growing area of corporate bonds, both hard currency and local currency. And on the left, you've got a range of equities. You've got large cap emerging market listed companies. You've got frontier market equities. We consider those to be in the universe, even though we have little exposure to them. And there's also a growing number of companies listed in the developed world that have got more than half their sales in emerging markets. So well-known companies like Unilever actually have over 50% of their sales in emerging markets, and we consider that to be part of the universe. So broad universe, 60-plus countries, equities, and varieties of bonds. And just to illustrate portfolio construction, just for a second, if we look at 3 different areas of the world, if we look at Mexico, where we find the bond yields rather attractive, in that country we tend to own more fixed income, the orange part on this page, than equity. We do have some equity, but much more fixed income. In India, which we, like many, find very attractive. We have actually quite a balanced portfolio of both Indian equities, and there's a lot to choose from, and Indian fixed income, giving us nice, secure 7% plus yields. And then if we move to China, for example, you can see we are entirely equity focused, no Chinese fixed income whatsoever, and also how we've reduced our exposure over the last year. So, country by country, we can take a different approach. Where equity, if we find that attractive, we can buy that, and if we find debt attractive, we can buy that. And just the final page of the presentation is just a sort of quick summary of how the returns we've generated. This is the composite for the 9 years to the end of September. We do it on this risk return chart. So on the vertical axis, you can see returns. The green dot is the emerging market equity index, and all of those grey dots are the Mercer emerging market equity funds. ETOP is the blue dot. So over the last 9 years, we've given investors returns similar to some of the best EM equity funds. We're not saying there's a fair comparison, but it's similar returns to EM equity funds, but with significantly less volatility. So the horizontal axis showing the returns of EM equity funds clustered in the sort of 20-25 range, and ETOP is sort of at the sort of 13% range. So EM equity-like returns with lower volatility, we would say we've delivered for the last 9 years or so. So I think I'm a couple of minutes ahead of schedule, but we are happy to stop, and Jenny will take us through some questions if we have any. Thanks for listening.
Richard, thank you so much. That was really fantastic, very insightful. We have had some questions pinging in. So the first one that has come through is asking, following the Trump election, how is your ETOP portfolio positioned to benefit from the new environment, and also, I presume, to protect yourself from the new environment?
Okay, well, we kind of expected a question like that, so no surprise. I guess, by brief way of introduction, I mean, at the sort of headline level, the Trump election looks like a negative for emerging markets. You have to admit that a more protectionist approach from the US, possible hostility to China, and just general uncertainty. Emerging markets don't do well in a more uncertain environment, are probably a headwind. It also looks likely that with long-term US interest rates rising quite significantly, that will sort of lengthen the dollar bull market. So if the dollar is stronger, that's also a headwind for emerging market currencies. So the sort of the high-level negatives there, I think, are well known and well reported on. We would try to be balanced and say that, obviously a stronger dollar, if you are an emerging market based company and you're exporting to the US, the strong dollar helps you. If you're competing with US-based companies in your home country, then that fight is easier with a strong dollar. If we do see boosts to the US economy, which already has got low unemployment versus the last 10 years, that's going to help the infrastructure sector. Tax cuts, both corporate and individual, should help that US economy. Well, that helps emerging markets companies who supply the US. That's a good supply background for them. And specifically for ETOP, I mean, we've assumed that the two countries most at risk will be China and Mexico. We have in the year up to the US presidential election reduced our China exposure quite significantly. If you look back, you'll see we're at around 5.5% at the moment. A year ago, we were nearer 10%, and 18 months ago, China was our biggest single country exposure, so that's been reduced. And in Mexico, we see much of the impact through the currency, and we can and do hedge individual currencies and have hedged some of the Mexican exposure back to dollars. So that's another way we can protect ourselves. I wouldn't overplay this, but I did a meeting recently. It was in Geneva, actually, and one of the clients suggested that if you look at what's happening in the US with uncertainty around Trump, you look at Europe with Italian referendum, etc., they did suggest that emerging markets might be a safe haven in all this turmoil. And we've run emerging market portfolios for a long time, and the idea that they're a safe haven is probably controversial, but I thought it was an interesting aspect. But anyway, we would go back to that point on valuations. Don't forget, valuations of emerging markets do seem to be discounting a lot of bad news already.
Yeah, I like that idea of safe haven. Haven't heard that about emerging markets before. The next question that has come in, what are the most important factors you look for when deciding to invest in emerging market fixed income or equity?
So for this portfolio, we go back to our objective of delivering emerging market equity-like returns with lower volatility. So, in the fixed income world, broadly, you can say at the moment that there are two areas of emerging market fixed income. There are the very safe, secure dollar bonds, which give you yields of 2 or 3% more than US Treasuries. Well, are they going to give you EM equity-like returns in the long run? Our view is no. So we've shied away from that area of the market for a year or so. So we end up with a debt portfolio that yields 7.5%, and that's close to what we'd expect emerging market returns to be. So we end up with quite a high-yielding EM equity exposure. Within the equities, actually, what we look for is attractive growth versus the valuation, and at the moment we tend to find that in the more cyclical areas of emerging market equities. So you'll find us having quite a bit of industrial exposure, consumer discretionary exposure, some energy and materials exposure, but actually very little things like healthcare, utilities, and consumer staples, which we just find too expensive for the growth we're getting. So every new investment needs to be measured against that mantra of, will it help us deliver EM equity-like returns with lower volatility, and that's how we do it.
Great, thanks so much. That was really interesting. The next question that comes in is, what is your main reason behind lowering your exposure to China so significantly?
Well, the China exposure is a result of the bottom-up opportunities we find. No one says we're going to reduce China. We effectively buy on a bottom-up basis companies we find attractive. If we go back a couple of years, we were finding interesting individual investments in China in sort of quite low risk, low technology areas. So one of the investments that paid off well for us was we had investments in two train manufacturing companies, CSR and CNR, the China Southern Railway and China Northern Railway, on the basis that they looked likely to merge. We held them for several years. They did merge about 2 years ago, producing very nice returns as they moved from being a purely domestic Chinese competitor to more of a global competitor. Some of those stocks did quite well, and we were keen to sort of lock in those gains. And the second thing that happened, and this is particularly after some of the Chinese currency moves, is that the Chinese stock market started to move much more in tune with other emerging market stock markets. If you want to get technical, and if you draw a chart of the correlation of Chinese equities versus MSCI EM ex-China, it actually increased significantly around a year ago. So if you're managing volatility, a more correlated investment with the rest of emerging markets becomes less attractive. So we had profits to take, and we had an area that was more correlated with emerging markets, and I think they're the two things that led us to reduce that exposure, in brief.
Thanks, Richard. Another question. What is the current asset mix in the ETOP portfolio, and can you talk about how the allocation is made in the portfolio?
Yep, so the allocation is really the result of the bottom-up stock and bond investments. Through the history of ETOP, we have been as high as 56% in equities and as low as 29%. At the moment, we're around 40%, so mid-range. As I said, that is in a group of more cyclical, more volatile equities, if you like. Our bonds are currently around 46% of the portfolio, and there again, we are at the higher yielding end with quite a big exposure to local currency, where our point about currencies being attractive medium term is driving that. And then the final allocation is cash. So cash is around 14%. It's down from its levels of 12 months ago. So cash provides the ultimate protection against volatility, and it also gives managers the sort of dry powder, if you like, to buy things if we get some volatility. And I think many of the managers would say that if you are at the end of the exceptional quantitative easing and you are starting to raise interest rates in the US, you've got issues around Trump, you've got issues around Europe, volatility looks pretty likely on a 6 to 12-month view, and we would like the dry powder to sort of buy things if there are some serious sell-offs. But overall, pretty neutral in asset allocation. But it is, it's quite volatile equities, quite high-yielding fixed income, and that cash cushion to keep the volatility target.
Thanks. Another one. Do your portfolio managers manage across the asset class?
Yes, and I probably should have said that. So we've had 3 managers in from the outset, and we added a 4th a couple of years ago. And the idea was that we would ask each manager to try and deliver that objective of EM equity-like returns with low volatility. So the 3 of them do that, and we run all our money at Capital using the Capital system or multiple portfolio manager, and we blend those managers who all actually have very different underlying portfolios to give what we think is a sensible client portfolio. So think of it as a collection of high-conviction ideas across the EM asset universe, blended together to give a sort of a coherent, sensible client portfolio. And yes, each of them manage across the entire spectrum. Don't feel too sorry for them. They are supported by a very experienced analyst team. We've got around 55 analysts covering emerging market equities, sovereign bonds, corporate bonds, etc. We've been being long in the emerging market area. We've got a well-resourced team, so they're well supported, and every company we buy, every bond we buy is sort of accompanied by very extensive due diligence and very extensive analysis of the opportunity.
We've got one last question, Richard. Can you talk about how you are managing volatility in the emerging markets total opportunities portfolio?
Yes, so we use an industry standard model called Barra 1. We've customized it to make sure it's got good coverage of the assets we invest in. And what we do is we run each manager's individual portfolio through the Barra 1 model, and it tells us what sort of volatility that portfolio has. And the first hurdle they need to observe is that they need to have a portfolio with half the volatility of equities. And we then blend those 4 managers, I say, together, and we run the total portfolio through the Barra 1 model. So, if a manager wants to add a Brazilian equity, which is highly volatile, it may be that he needs to adjust his portfolio to reduce volatility in other areas. So if you think of volatility as the first hurdle that the managers need to sort of get over, but we use the Barra 1 model as a way of measuring that. It's not perfect. Like any risk model, it can only look back in time. We've worked hard on using shorter term models to try and capture short term changes, but the Barra 1 is the sort of fundamental way we try and measure volatility of the individual managers and the total portfolio as a whole. It's not in the slide pack, but we can show anyone who's interested not just the returns, but also the volatility. And I think we're happy that we've delivered less than half equity volatility over its lifetime.
Thank you so much, Richard. That's all we have time for, I'm afraid. But I'm glad to say we'll be seeing Richard and the capital investment team at FundForum International next year in Berlin, 12th to the 14th of June, where I'm happy to say they're a gold sponsor. We have been working incredibly hard on researching and preparing the agenda for 2017, and we're almost ready to announce it, which should be pretty exciting. So thank you everyone for coming along. Please make sure to keep your eye on your email box for information, not just about the future webinars, but also our launch of the FundForum International 2017 agenda. And thank you to Richard for joining us today for the discussion. That was incredibly insightful. So if you have any feedback on today's webinar or any recommendations for future webinars, please do complete our short survey at the end of this webinar. It should flash up on your screen very shortly. So thank you and goodbye from FundForum International.